Well, markets rebounded last week with risk appetite boosted by some solid tech earnings, excluding Meta, of course, as treasuries continued to sell off across the curve with new year-to-date yield highs being printed, and the dollar and G10FX taking a little bit of a pause for breath, although that, of course, excludes the Japanese yen, which has had an incredibly volatile start to the new trading week. It is a jam-packed week up ahead. The FOMC on Wednesday and the US employment figures on Friday, the highlights over in the United States, but it's a busy week more broadly as well, with 175 of the S&P 500 set to report corporate earnings this week, including Amazon on Tuesday evening and Apple after the close on Thursday. We've also got a Treasury quarterly refunding announcement in the mix as well, and a busy data docket on this side of the pond too, with the latest Eurozone GDP and CPI figures on deck as well. Tons, really, for us to discuss on the Trade Off UK this week. So without further ado, let's get on with the show. Well, it's certainly been an interesting start to the new trading week, given what's been going on with the Japanese yen. And joining me, as always, to try and make sense of everything that's going on is Ryan Littlestone from Forex Slow Live and Forex Analytics. And Ryan, before we crack on with the show, can I just thank you and all West Ham fans for the massive favour that you guys did us over the weekend?
No, well, absolutely my pleasure, mate. And now you're going to be relying on us to do Man City on the final game of the season. So good luck with that one.
Well, I will keep everything crossed for that one. Pretty much like the Ministry of Finance are keeping everything crossed that dollar yen continues to head lower, I suppose.
Yeah, very much so. It's been a long week today.
Yes, indeed. We're recording this at 2:00 on a Monday afternoon, and I'm sure I speak for both of us when I say, like, it feels like we've traded and worked our way through an entire week already, and we've still got 4.5 days left to go. So I wonder what fireworks the market will release on us as the rest of the week goes on.
Yeah, if it was anything like what we've had this morning, then it's going to be fun and games all the way through. And yeah, we're going to love it because that's what we're here for.
Yes, indeed. Certainly games. Not sure whether fun is the right word. We will see about that by the time we get to Friday. But why don't we dig into some of those themes in a little bit more detail in Topical Thunder. So we'll let our resident Tokyo correspondent cover the Japanese yen in a moment or two. First things first, though, I want to dig into the FOMC, because in terms of scheduled events this week, that is by far and away the most important and the biggest risk event for markets to navigate. And I think the May FOMC decision comes at an interesting time. Of course, it's the first time that we will have heard from the FOMC since that hotter than expected March inflation data, which marked, of course, the third upside surprise on headline CPI in a row, albeit, of course, the Fed targeting PCE as their preferred inflation gauge. But nonetheless, as Powell said in his remarks at the IMF recently, recent data is not giving the Fed the confidence that they require and the confidence that they seek to assure them, or reassure them, I should say, that the disinflationary process is still underway. And of course, it's also the first time we'll have heard from the Fed since this huge hawkish repricing that's taken place over the last 4 or 5 weeks. We now have around about 34, 35 basis points worth of cuts priced into the curve over the course of this year. That's about half the magnitude of cuts that we had priced in when we last heard from the Fed back in mid-March. And of course, it's down from the 150, 160 basis points worth of cuts that we had priced in right at the start of the year, all the way back in January. Now, despite this, I don't expect a massive change in tone or rhetoric from the Fed this week. I think the statement is pretty much going to be a copy and paste of what they delivered back in March. It's a unanimous vote for the Fed funds rate to remain unchanged, reiterating that they are still seeking confidence that inflation is getting back towards 2% before they deliver any rate cuts, and all the while reassuring us and stressing that the economy is expanding at a solid pace. Yes, GDP was a bit soft last week, but there were some one-off factors influencing that, and consumer spending is still pretty strong. Job gains remain strong, as we will likely see once again in Friday's employment report, which we'll get onto in a moment, and that inflation has eased but remains elevated, which I think is a just explanation of the situation at the moment. And then you move on to the press conference, and I think that's likely to be pretty much a copy and paste of what we've heard recently as well. Powell repeating what I just alluded to at the IMF. There's been a lack of further progress, and they need to give policy more time to work, and that cuts are still on the table this year. I think, though, that the press conference could be a little bit difficult for Powell to navigate, because it's almost certain that one or two or maybe even three journalists present in that room explicitly asked the question of whether rate hikes are on the table. Now, any, I would say, serious market participant at this moment in time does not believe that the Fed are going to hike again. And certainly if you take their commentary and their rhetoric at face value, the next move in the Fed funds rate is going to be lower. And that's certainly what I believe at the moment. But Chair Powell or any FOMC official or any central banker actually cannot explicitly rule out a rate hike, because they cannot hold themselves and end up as a hostage to fortune, even though it's not the base case and it's not really a serious prospect that rates are raised once more. And I do just wonder whether we perhaps see a knee-jerk hawkish reaction on, a Bloomberg headline crossing going, Powell, rate hikes are possible, without the full context of the question around it. If we do, I think that's a move worth fading. Just one last thing on the FOMC before I get to you, Ryan. We are likely to see them taper quantitative tightening at this meeting, cutting the Treasury runoff cap to probably around 30 billion a month. That would be just under half the current pace of runoff. Mortgage-backed securities probably going to remain unchanged. This is a little bit technical, but effectively it means a slower pace of balance sheet runoff probably means you can run the process for longer with reserves remaining ample. That means the Fed ultimately end up with a smaller balance sheet, which is what they want effectively. But Ryan, how are you viewing the FOMC this week? I think risks are arguably more skewed to perhaps a dovish reaction, given how hawkishly the market is priced at the moment. But I'm keen to get your view on that as well.
Yeah, well, firstly, I'm not sure our mutual friend Dickie Matthews is going to appreciate you calling his view not serious at all. Saying
I just say this to make sure he's watching now. That's all it is.
All right, bit of a fishing trip. Okay, I'll get you. I think this is going to be maybe just a bit of a bigger event than maybe you're expecting, because we've had this data coming out, this CPI staying sticky. We've had PCE, which came in higher on one of the measures and unchanged on the core measure. That's now reflecting the stickiness that we've seen in the headline CPI data, which has been going on for 10 months, as we've been pointing out on the show. So there's every chance that Powell needs to say something. The market knows or thinks he needs to say something to reflect that. We had that with his press conference or his fireside chat with BOC's Macklem the other week, where he said it may be appropriate to keep rates higher for longer. That was a very specific line, the sort of line you read in an FOMC statement. So I'm wondering if that's going to appear in there alongside the cut language. And that's what the market's going to be focusing on. Is the cut language still in there at the same sort of level language that it's been right now, where they still perhaps see it appropriate to cut rates sometime this year? The dots are indicating 2 cuts this year in the median, or is there going to be a subtle change? Is it going to be pushed to a more higher for longer, maybe a little bit of a drop out of that cut language? Obviously, to the extreme is going to be putting hikes or anything like that in the statement. More so than we've got the Fed are ready to adjust policy on either side sort of conversation. So, yeah, the market, as we know, got a bit more hawkish about the Fed. We've seen rate cut expectations change. I think at one point last week we were not seeing any cuts until December, and as you say, from 160 pips start of the year. So the market is moving down that extreme range. We're not overly extreme yet, but it won't take much to get us there. And Powell's been good at walking that fine line, giving a bit on one side, taking a bit back on the other. He's got a job on his hands this week, though.
Yes, he has. It's certainly a very delicate balancing act that he's going to have to try and pull off, and we will see how well indeed he does that on Wednesday evening. Right, let's move on. The Japanese yen, Ryan, you've been talking about it for months. You've been busy this morning trading it. You've been even busier arguing with Muppets on Twitter who don't believe you while trading it. What's going on with the Japanese yen, my good friend?
Yeah, it looks like they finally lost patience. Who,
the Ministry of Finance or your mate on the internet?
Well, everyone's lost patience at the moment. But the Ministry of Finance will stick to those guys for now. And they saw enough in the Asia time zone to come out fighting, apparently. And I say apparently because as much as it looks like intervention, they very rarely come out and confirm it right away. Although we've had the top FX man, Kanda, he's been out with no comment. remarks over intervention, but then he later said that they will continue to act against excessive FX moves. So that's maybe a little hint that they have. He's also playing games as we're due to get the Ministry of Finance's monthly FX intervention report for April. That always comes at the end of the month. And obviously, recent months, there's been zero intervention, but now they've intervened right at the end. We don't know whether that was going to appear in the report or not, given a clue as to whether they had. He wants to keep the market guessing because he said any intervention will be disclosed in the May report, which will come at the end of May. So he does want everyone guessing, and that's their MO. They don't want to, give the impression or give the confirmation, even though everyone knows it's likely. So that's taken a little bit of headline risk away, because if we got a headline from this April report where it shows no intervention, but they only counted it up to Friday, then you can see one of the newswires playing a bit of shenanigans with that headline and saying, they didn't intervene in April, and then the market goes and ramps up dollar yen again, and then everyone reads the details. But anyway, so we got dollar yen. It got bid up to over 160s, 160.20 overnight, before then getting hammered down in this suspected intervention down to 155, which was a key level to hold initially. We then had a bounce early morning in Europe to 157.20s, and then that got another slap down to 154.5. And we won't know if that's second intervention or not, but it might just be a nervous market, but it does smell a bit like secondary intervention as well. As you said, I've seen a lot of comments going out on Twitter and elsewhere saying it's been a waste of money or it's had limited impact, but those people obviously don't understand how this works. They're not intervening to set a level. They're not intervening to send yen pairs down a certain amount. They want to take the speculative aspect and volatility out these moves. That's all they're trying to do. We still might go higher and back through 160 and even further, but it's how we get there and how it does that is important. If it's volatile, like we saw last night, and speculative again, they'll likely hit it again. If we grind up there and over 3-4 weeks to 165, that's a different thing altogether. But for now, we should expect volatility to remain high and yen pairs to be very jumpy. It's important to know that if you are trying to trade it. And for now, I'm just sitting on my hands because this sort of volatility doesn't fit in with my risk parameters. So I'm sitting here with a popcorn watching what's going on.
I think that's very sage advice, and actually I wouldn't be surprised if a lot of people are doing the same, because, as you say, it is akin to a guessing game rather than there being any sort of rational moves in the yen, certainly over the last couple of trading days. Very, very comprehensive wrap, as we would expect. A couple of things I would add. One is that Kanda did say in one of his many comments this morning that it would be in the May report that any intervention shows up rather than in the April one, presumably because of T+2 settlement, which means that it wouldn't actually show up until the 1st. But anyway, we'll have to wait another month. So he's teasing us a little bit with that one, which brings me on to another point, which is actually the kind of vagueness around all of this, which we're seeing from the Ministry of Finance now, and which is typical from the Ministry of Finance when they do intervene. It works in their favour because they will want to keep the market guessing. They will want to keep that risk of further intervention or further sudden moves, stamping down on weakness in the currency, sort of hanging over markets like the sword of Damocles, because it will sort of, as we just alluded to, it will keep speculators away. It will have the effect of stopping folk from potentially chasing any further weakness in the yen. And of course, as you rightly said, Ryan, this isn't about moving dollar yen to a specific level. This is about saying we want the yen to trade in line with its fundamentals. If it isn't, or if we don't believe it is, we will come in and make sure it does. And I think in order to do that, you not only need the monetary intervention itself to move it sort of 5 big figures, as we saw today, but you also need that threat of, yes, we will do it again if we believe this is happening. And by not confirming that they've stepped in, it does leave that threat sort of hanging over the market. And that will, you would expect, discourage further speculation, which is sort of the second round effect of what they're looking for from stepping in the early hours of today.
Yeah, very much so. And, we have to look at how these interventions happened previously. When we had the interventions in 2022, that didn't stop dollar yen from rallying all the way to 152. It was really only the turn in the US fundamentals. We had the inflation dropping down from July that year. Then towards the end of the year, we had the pivot brigade coming out and trying to guess the top in Fed rates and saying this is going to be it, and they had a go at that. So it took a fundamental change. The same happened in 2011, 2012 when they were last intervening then as well. Into 2012, we had Abenomics coming in, and that really changed the tide from down to that 75, 78 level. So they need something to change the mood of the yen significantly and fundamentally. So without that, we could continue playing this game for a while longer.
Yes, absolutely. It feels like half the world are praying for a soft non-farm payrolls print on Friday, to be quite honest with you. It would give the Bank of Japan and the Ministry of Finance a massive helping hand. A whole bunch of other Asian currencies seem pretty concerned about the moves that we're seeing against the dollar. And it would certainly give Chair Powell a helping hand too. And Kyriakos will give me a helping hand in a second and move this slide on because I want to talk, there we go, about the non-farm payrolls number, because it is, as is typically the case, the first Friday of the month. And that does bring us our latest read on the US labour market to wrap up well, it's already been a busy week. I've written here another busy week. It's only Monday. I can guarantee it's going to be a busy week over the next 4 or 5 trading days. In terms of our expectations, headline non-farm payrolls, they're seen rising 250,000 in the month of April. That's a modest slowing from the 303,000 that we saw, pending revisions, of course, in the month of March. Sorry, my mind went totally blank there. Although that 250,000 pace is broadly in line with the pace that you would require to see what we call the break-even pace, which is the rate of payrolls gains required to keep up with expansion in the labour force. It would be marginally below the current 3-month average of 276,000. That is a 12-month high. If you get a print in line with consensus and there's no significant revisions, then you should see that 3-month average at around 270,000. So nothing too much to worry about there. There aren't really any leading indicators for the payrolls print at this moment in time because of the timing. It's coming out on the 3rd, which means the usual PMI surveys, certainly the ISM services gauge, that will be out after the payrolls print. The ADP number is entirely useless, so just ignore it. We did see initial jobless claims and continuing claims actually remain pretty much unchanged from one survey week to another, so that doesn't give you too much of a steer either. Other areas of the report, sticking with the establishment survey, average hourly earnings, they're set to rise again by 0.3% on the month. The year-on-year rate should fall to 4 from 4.1% previously. That's almost entirely a function of tougher comparisons from where we were last year, skewing that year-on-year number a little bit. Modest real wage growth, depending, of course, on where the April CPI print comes in, but real wage growth of somewhere around 0.5%. Probably not too much concern for policymakers, although it does pose a modest upside risk to services prices still. And in terms of the household survey, unemployment expected to hold steady at 3.8%. That's pretty much, as near as makes no difference, where it's been since the 3rd quarter of last year. Participation expected at 62.7%, which is just a 1/10% off the cycle highs that we saw towards the tail end of last year as well. Although I do think we're going to see the household survey remain pretty volatile over the near term as the impacts of immigration continue to distort the numbers a little bit there. That is something that is becoming a greater influence on the figures. All in all, I think the figures should show the labour market remaining pretty tight. There don't seem to be too many cracks emerging just yet, but I think the policy implications of the payrolls print and the employment report on the whole are likely to be relatively limited. If you think back, obviously we'll hear from Powell on Wednesday, but if you think back to what he was saying in March, he was saying that strong hiring by itself is no reason to delay rate cuts. And I think if you look at how the Fed are acting and certainly look at the incoming data, the inflation side of that dual mandate, certainly with the labour market remaining pretty resilient, by far and away is much more important in driving that reaction function than jobs at the moment. So in terms of a knee-jerk move, yeah, we may see one. I wouldn't worry too much about it. In terms of a prolonged move and any policy implications, the next CPI print on the 15th of April is really where attention should be on that front, I think.
Yeah, I mean, this again, you're sounding a bit complacent, so I'm hoping that's a kiss of death and we get a big wild report because that's why we're all here. Yes,
it's not. Not a Friday afternoon in the sun. It's not.
Yeah, well, your fall down there is the sun part.
Well,
But
yeah,
anyway,
true.
yeah, we've been waiting for this one to turn for forever. Even the Fed have been waiting for this one to turn, given where rates are. I think there's a danger here when we do get a bad number, which we will eventually do, of seeing a big market overreaction. Now, why it's important this week particularly is because we've got the FOMC on Wednesday. So whatever Powell says, let's say he's a bit more hawkish, and we see dollar rally, yields rally, and he paints a rosier picture. And then Friday we get a stinking NFP. We're just going to completely flip that around, and that's the market we're in at the moment. You can't have a bias. You can't have a trade going one way forever, because you get another data point and it flips everything on its head. So we've got to be careful with this of a bit of an overreaction. The numbers are doing fine. My main watch is going to be those wage numbers, those year-on-year wage numbers. They've been sticky around 4% for, I don't know, 6 months now, might be a bit longer. And that's going to keep feeding that inflation fire a bit longer. But as for the rest, and if there's no real big shocks, and even if there is a bad number, it's been on such an incredible run, you can't then turn around and say, oh, this is it, this is the end, this is the beginning of the end, if you like, and the jobs market's going to fall off a cliff. May do, but it most likely won't as well.
No, I fully agree with that one. The only thing I would say is that arguably the most, or potentially the data point that has the most potential to become politicized as we move through into the presidential election campaign is labour market stats. If you see one or two negative non-farm payrolls prints before the presidential election in November, which, let's be honest, that is still, 7 months away at this moment in time. So you probably get 6 jobs numbers between now and then. Distinctly possible one or two of those are negative. That's not going to be a disaster if they are, but just you wait until the politicos pounce on that one and it's all over campaign materials. And that's when things really do start to get unbearable. In any case, we best move on because it's a busy week in the Eurozone as well. It's not just the US where there's focus this week.
Yep, and we're going to be watching the Eurozone data to see if it seals this June cut that everyone's expecting. Now, we're fortunate because Kyriakos is going to get this video out right on, really early. So hopefully this analysis is still valid by the time we get there. But we got a raft of Eurozone inflation data. Some countries have already printed today. Spain was a little bit higher, one down on another. Germany has come in largely unchanged. Their regionals up and down, and the headline number coming in around an expected 2.3%. We get the pan-Eurozone number on Tuesday, and that will be traded, obviously, for what it means for the June ECB cut. Now, we're expecting an unchanged headline number of 2.4% year on year, and the core to drop to 2.6 versus 2.9% previously. So in theory, the core should be following the headline with a bit of a lag, as it tends to do. So it would be a huge surprise to see that coming in close to unchanged or even higher there. However, the headline's going to be more interesting. We've been seeing this sticky inflation in many other countries, but not really in Europe. And one reason for that might be that Europe's just lagging others. It's a bigger block. Another reason might just be that because growth has been, flatlining for the last couple of quarters. So there's little activity to cause prices to rise domestically. We'll know, also firms, if in that scenario, undertaking price cuts to stoke up business. So we're not seeing that domestic inflation pressure. Now, if we do see the headline number jumping, we'll know that it might be the former reason. If we see inflation dropping lower than expected, then we're going to be really pricing the June cut, but more so what it means for a July secondary cut. Now, given that pretty much every ECB Council member has greenlit June, the only trade really now is how quick another rate cut may come or not. And that's going to be my question to you, Michael. If they do cut, if June is done, when do they cut next?
God, yeah. You do every week. You've started to do this. Just give me a devilishly difficult question right at the end. Just as I sort of metaphorically put my feet up at the end of this segment. My base case is that they cut quarterly from June. I think that is and actually I would say the same for the Bank of England, to be honest, while we're talking about the pace of cuts here in Europe. I think that's a relatively slow and methodical pace at which they can go at. It gives them a chance to examine the effect of, or the immediate effect of a rate cut before delivering another one. And of course, with the ECB, it has the added benefit of they would be moving in terms of cuts at meetings where they produce economic projections. You'd go June, you'd go September, you'd go December. I think any quicker than that, the ECB run the risk of sort of showing the market that they're panicking a little bit in terms of either undershooting the inflation target or in terms of how fragile the economic backdrop may be. So my base case would be they go in June and then they go in September. But I think there is going to be an almighty debate, dare I even say row, among governing council members between the June and July meetings, because there are going to, well, there already are plenty of doves out there who are saying, you know, we could cut or we should cut twice before the ECB's summer break, which is obviously after the July meeting. And then at the same time, you've got some of the hawks out there saying, we'll go in June, but, you know, we can't say at all what's going to happen after that. So it's going to be interesting. I would imagine that the consensus is still towards cutting at a relatively controlled pace every 3 months. But if we see inflation dip back below 2% on that headline metric, and certainly if we see it under 2% on the core number, then that is really going to, you know, give the doves the upper hand, and we may well see them cut at a more aggressive pace. Of course, the other consideration is what the Fed are doing. The ECB seem to love worrying about that. No one else seems particularly bothered apart from ECB policymakers about that one. But if they cut quarterly, they'll be sort of in line-ish with what the Fed are doing, maybe 25 bips ahead or so. Whereas if they cut more aggressively than that, then obviously that rate differential is going to widen, and you'd expect further pressure on the euro as a result. But we won't get into the weeds of that one now.
Okay, we won't then.
I just looked at the clock and I've seen how far over time we are. So let's get on with some charts. I think that was me waffling about the Fed for far too long, which took up most of the time there. But never mind. Let's get into some setups this week. I want to look at the S&P 500. The Bears had a bit of fun for a couple of weeks, and normal service has now resumed, thankfully, with dearie me. Yeah, I can't even say.
I'm not dipping anywhere, mate.
Oh, it's all going wrong. What I meant to say was that dip buyers appear to have prevailed once more. We did have a nice rally in the S&P 500 last week, up about 2.5%, very much tech-led. We saw the NASDAQ up just over 5% last week, 3.5% last week, if I can read my notes. And we had more than 10% rallies in Google, Microsoft, and Nvidia, plus a decent rally in Tesla as well, all helping to move the market higher. And of course, from a technical perspective, we've had a nice bounce off, and a very clean bounce actually, off that 100-day moving average in the front future and off the 5,000 figure in the front future as well. So I think the path that leaves resistance continues to lead us higher. The policy backdrop supportive. Earnings growth has been relatively solid thus far, and growth, albeit that GDP number surprised to the downside last week, growth is still pretty resilient. Consumer spending is still pretty strong, and that should continue to support earnings as we move through the coming quarters. So I continue to like buying dips and remaining long here. If we had a closing break north of that 50-day moving average, which the market is just probing as we speak, then I'd be looking to perhaps add to that position. And if we do get any knee-jerk weakness over either Jay Powell's press conference on Wednesday evening or the payrolls print on Friday, then I think that is probably there to be faded, because in all likelihood, the next move from the Fed will still be a cut. And if we get a hot payrolls number, well, actually, what's the problem with that? Because a tight jobs market should continue to support growth, and it should continue to support corporate earnings as well. So normal service has resumed in the equity market, even if I can't get my words out.
Yeah, well, I'll try and do a bit of a better job.
Won't be hard.
Yeah. It's the old saying, you can't keep a good stock market down, and this one's bounced back, quite significantly. It's always a measure of a market, and that's why I use fibs a lot in trading to see, is a trend really changing around? Yes, this has been a significant move off the highs in the 52s. But we couldn't even get down to the 38.2 fib of the whole rally or this phase of the rally that started late last year. So that shows you that this at the moment is just merely looking like a correction. Top side is going to be important. Where are we going to run into trouble? back into that 52 area, 51.50s, that sort of area. If we do, then maybe we start to build a bit more of a solid top, and we see some longer term lower highs coming in. But failing that, all eyes are going to be on that recent high over the 52 handle, and then we're going to see, are we going to move on to fresh highs, or does that become a bit more of a top side level to look at and rely on, a bit like the 4800 level was all those months ago? So lots of trade here. We're a bit in the middle at the moment. We know the marker on the downside, as you say, down into that moving average, and we know the main level up top towards those highs. So if you don't want to get caught in the middle here, just wait for a move to either one side or the other.
Indeed, very well put. Right, dollar yen next. You mentioned him earlier. We've got a chart here that goes back to almost when Dickie Matthews started in the city, I think.
I know. Were you even born back then? I'm not too sure.
That's a long way before my time.
So there we go. Some history for you. Yeah, I've been.
I think it was before your time as well.
Oh yeah, I was quite young then. Yeah, but yeah. In the 90s, I was early 90s. I was just making my way in the world. So yeah, I was around for some of this stuff. But yeah, I've been at my ease all this morning. Putting together the chart for this one. Now I want to keep this set up fairly simple. We've had a big move both ways. We opened Fridays, as we said, 155. Had the BOJ meeting, ended Friday above 158, went to the 160s Monday morning, and now, as I was making these notes, we were at 155.86. We're currently at 156.49. We have been as low as that 154.5, so we're really jumpy as a box of frogs at the moment. Now, this situation is why I've only really largely been focused on the bigger, longer-term levels, one of which we tapped in that rally this morning, the early hours of Monday, in that 160 area. Now, that area is a historical series of tops going back to 1990, and that's in that box I've highlighted there. If you scroll back, take a look, you'll see it's a series of 6 weekly highs there. So that area also contained other interactions going back to 1986 or even further back. So for me, it's an important level. Now, by luck, divine intervention, or whatever you want to call it, we topped out right there in that zone, which confirms it as a level for me. That at least gives us something to watch moving forward. Now, as for the downside, well, we might have had some secondary intervention, as said, in that bounce, that first bounce from 155 to 157.20s, but we haven't been able to go sub 155 since then. So that looks like it's the level, our key level on the downside, to keep watching moving forward. If we do move under there, it's really the 152s as defined on the way up, and by that yellow 38.2 fib, you can see it's 152.77. Now, I cannot stress enough how volatile trade in the yen is going to be for a while. So if you do trade it regularly, don't trust your short-term levels much, and make sure you know where the bigger long-term levels are. As proved today, if they're big enough, they'll show up. Now, just for the record, I did start shorting this on Friday. I had an intention to short it all the way up to the 160 area. One, because it was a big technical level, but I also thought it might be a bit too far for officials in this round. Unfortunately, I didn't leave any orders in to hit it on the higher if it did move higher, and I wasn't expecting that move when I went to bed Sunday night. Still, I TP'd first thing this morning, but I'm now sitting on my hands again because I'm going to be watching to see what the market wants to do. But I'll be watching this 160 level again if we have another look, because I think it's going to be the key level here.
Yes, indeed. I think you're absolutely right. It is going to be interesting what happens if and when we get back towards that 160 handle. I think for me, as we said earlier, the intervention is designed to sort of wash out a few speculators from the market. But I think fundamentally, you're still looking at further upside here, particularly as the BOJ are taking a sort of snail's pace approach to tightening things up, and as the balance of risks tilts relatively hawkish for the Fed. So it is going to be interesting what happens when we get to, or if we get to that level again. And I think whether or not we see another round of potential intervention, and I guess we have to call it still at this point, depends on the speed of the move, as we covered earlier. But nonetheless, historical context absolutely key, given where we're trading at the moment. Right, let's have a look at gold. I'll keep this relatively short and sweet, but it does seem and feel a little bit like gold has run out of steam over the last couple of weeks. I know Ryan brought up the yellow metal this time last week, and it seems like we're settling into a little bit of a range at the moment between $2,300 an ounce to the downside, which we probed and held a couple of times on a closing basis last week, and $2,400 an ounce, and the couple of the one all-time high above that at 24.32 to be precise. I think this is an interesting one because, as we've both spoken about at some length, gold moved higher presumably by the hands of some as a result of some sort of mystery buyer within the market. All of these typical cross-asset correlations that you see really weren't moving in favor of the yellow metal. In fact, they were moving against it. Yields moving higher, the dollar strengthening, and risk appetite remaining relatively firm. All the while, gold rallied, $400 from the lows that we saw earlier in the year. And I just wonder whether we're now going to start to see potentially those correlations begin to reassert themselves, all of which point to gold trading a fair chunk lower than it is at the moment. And I think for a technical basis, at least, if we get a closing break below that 2,300 figure, then you could see any remaining longs begin to look for the exit and bail out. And of course, any bears would love to pounce on that move lower as well, particularly when you think about, given the speed of the move higher, the next real support doesn't come until that 50-day moving average, which is around the $2,200 an ounce figure. So range bound for now, but I think downside risks are intensifying a little bit for the yellow metal.
Yeah, I'm going to have to get you getting some fibs on these charts because they are important for these.
Oh, let me get an Elliott wave on there as well. No, and I'll throw a moon cycle in the little panel at the bottom. And
I've set him off now. Look, you got to broaden your horizons, mate. And the reason technical analysis work is because everyone's looking at them. The more people looking at them, the more they work. They don't work just because they're funny colour lines on the screen. But anyway, I digress. I don't have much to add to what you said.
Well, no, you just had a rant instead.
2,300, 2,400. That's your range for now. Like you say, if we close below 2,300 and it's confirmed that we're below it, i.e. retests hit that as resistance, then we're heading for more downside. 2,400. If we get above there, then we have to take out those highs. So it's a good range to trade for now. If it holds, then there's good money to be made in $100 range, and you can always go with the breaks either side if they do move. But that's it for now, and I'll give you my technical analysis lesson later.
Well, I look forward to that in due course, mate. But before you get to that, why don't we cover what's going on at the front end of the curve?
Yeah, looking at what potentially is the big dollar decider here. The Fed, we're in that what happens next game, and it's going to be played out in yields, and 2-year yields is the one we should be watching right now. On the chart, you can see the white line represents the effective 2 rate cut medium forecast of the Fed. And as you can see, we're well above that. We're roughly, sort of 1.5 cuts below the current rate. So we've been holding this 5% level for over 2 weeks now, and that's helped keep the dollar largely contained in most pairs. Now, as discussed, obviously, if Powell and co are leaning less dovishly or even hawkishly than they have been, we're going to see the dollar jump in, and it's going to be important to watch what yields do, particularly here in these 2-year yields. Now, if they bust higher as well, then that will give a helping hand to the dollar. But if the bond market looks less reluctant to sell off, i.e. push those yields higher, and we can't hold a break of 5%, then we could see any dollar rally hitting the skids pretty quickly. Now, I feel I've been saying this a lot lately in various assets and the like, but where we close the week here in 2-year yields could be the most important factor for the dollar post FOMC.
Yes. Sorry, I thought there was more coming.
Wake up!
That was a little bit of a cliffhanger that you left me on there. I thought there was going to be more. I think I mentioned this either last week or the week prior. I actually think twos at 5% are are a buy, in my view. I think there's going to be plenty of people out there, and I'm glad you put the median, well, not even the median, the where we would be in terms of 2 rate cuts. The median is obviously slightly below that in terms of 3 cuts, but I'm glad you put that on there because it just shows, I think, that 2s are a little bit overdone here at this moment in time. And I think plenty of people out there are going to be looking at the front end of the curve and saying, 5% for 2 years when the Fed are probably going to start their easing cycle within the next 6 months. That's a juicy enough yield that I think plenty of people will be looking to lock that in. We will obviously, I would imagine, need to navigate the quarterly refunding before we perhaps see those flows come in. The refinancing estimate is out tonight, actually Monday night, 8 o'clock London time. And then we get the actual breakdown in terms of how that's going to be split across the curve on Wednesday at around about 1:30 in the afternoon. I don't think that's going to be too much of a major event, but I think it's just one, let's get it out of the way before anyone really begins to plow into this trade in size. But I do like, I think that the front end is going to rally over the medium term. And as a result, I like 2-year yields lower and price higher from here on in.
Yeah, it could be, mate. But if we get a pretty hawkish power, then you might be getting better than 5% at the moment. And that's something, as I say, that market's going to look for. And if we do rally up, it's going to be interesting to see what the bond market does with it. Does it start buying bonds based on that higher yield, and then we see it coming back under? But this is one every trader needs to have open over the FOMC.
Yes, absolutely. I was going to make a point on bond maths there, but we're running low on time, so I shan't. Let's move on to our plays of the day. It's important. It's not yawn-worthy. It's an important point, but it will remain in my back pocket now. Don't you worry. Let's move on.
Do a video on it tomorrow.
Sorry?
Or something. Go and explain a video on it tomorrow or something.
Oh, there we go. I shall. Right. I want to talk about the Swissy. I sort of touched on this last week, but I want to dig into the Swiss franc in a little bit more detail. It's something that I've been bearish on for quite a while now, actually, and just going to revisit it ahead of the Swiss inflation figures that we get on Thursday morning. We're expecting a modest uptick in CPI to 1.1 from 1% prior. That is still, though, right at the bottom of the SNB's target band, and of course, significantly lower than we see in other developed market economies. And I think that should be supportive of a second straight SNB cut in June. And the Swiss OIS curve seems to be massively underpricing the chances, not just of that, but also in terms of cuts by year end, pricing just 43 basis points of cuts over the remainder of the year from the SNB, which seems significantly underdone, particularly when you think the ECB are going to deliver at least 75. You would expect the SNB to want to keep up with that. And of course, they only meet quarterly as well. So couple that with the policy divergence that we should see between the SNB and the FOMC, as we covered in last week's show. I like dollar Swiss higher, i.e. bearish on the Swissy, a close north of this 91.50 level, which is pretty much where we were trading earlier on today. That could really be the kicker for the next move lower in the Swissy. And then we move towards, you would expect, the September-October highs around 92.25. You can also put a stop just under that 91 figure if you wanted to make things nice and tight. So that's what I'm looking at this week. Ryan, you're looking at your old favourite again.
Yeah, my old favourite, and trying this 85 handle again. And this one's becoming a bit of a rinse and repeat trade. And, we're here to trade. So as long as it works, we keep trying it. Now, long-term viewers, as you will know, that I like trading off this 85 level. I'm core long in this pair, and I offloaded a good chunk of that in the recent rally up to my resistance zone up in that 86.40 area. We're heading back down towards 8,500 again, and I'm keen to add to my longs to play the ranges once more. Now, the key item of data that's important for this trade this week is that Eurozone CPI data. If we're coming in around expectations, then I'll be looking to pick up another run down there should it happen. However, if we get a far weaker number, say CPI close to or at even under 2%, that will be far more dovish, and I'll be wary of perhaps seeing a break. But if we get weak data and we still can't break the level, then that will be my clue to buy some. So, yeah, I know it may sound a bit boring when I keep coming back to this one, but it keeps working, keeps making money, and that's what we're here to do.
Well, indeed, as you rightly say, and sometimes the boring trades are the best ones. Right, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for firstly bringing this together as brilliantly as he always does, and secondly, for doing a super speedy edit to get this out a little bit later on today, given the vol that we're seeing. Hopefully you've enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, your thoughts on what we've discussed, and if there's anything you'd like us to bring up next week. And that is indeed when we will be back with another episode of The Trade-Off. In the meantime, thank you once again for watching, and goodbye for now.